Welcome back. Canada's debt issuance is projected to exceed levels seen during the COVID-19 pandemic era. That's according to Finance Canada, with the government now planning to borrow $612 billion in the fiscal year of 2025-2026. This raises concerns, of course, about rising debt levels in Canada following the recent downgrade of U.S. Treasuries by a credit rating agency. Many people worry that Canada could also face a debt downgrade if it doesn't rein in fiscal spending. Let's welcome Randall Bartlett to the program. He's Deputy Chief Economist at Desjardins, and he joins us now. Randall, thanks a lot for joining us. We'll begin with a graphic that you've provided us with that shows recent trends in debt issuance. Let's begin there. And of course, the subtext to this is that promises by our new Prime Minister and new government that spending on things like defense is going to be dialed up very significantly. Talk to us about trends in federal borrowing.
Yeah, so we received the debt management strategy from the federal government earlier this week, and so that's the expectations of the federal government for the amount of debt they're going to be issuing for the 2025-26 fiscal year. Typically, it comes with a budget or a fall update, but it came in the middle of the summer this time because we're not expecting a budget till the fall. So no big surprise in terms of the fact that we are expecting to see higher issuance this year than last year. In fact, when we saw the numbers from the federal government, we were a little bit surprised at how many fewer treasuries they're expecting to issue than we were expecting when we put out our forecast back in May. But overall, we're expecting to see bigger budget deficits than were planned back at the time in the fall economic statement back in December. And so as a result, there's going to be more debt issuance to fund larger deficits as a result of higher spending and lower taxes.
And in recent work that you and your colleagues have done, you've responded to questions that a lot of people are asking. Is a debt downgrade possible in Canada from AAA? And you began that work, I gather, by looking into, in some detail, the ratings methodologies of the three big agencies.
Yeah, that's right. So what we did was we dug into the rating methodologies of the big three credit rating agencies. We also looked at the Bank of Canada and its sovereign credit rating methodology that's based on S&Ps. And what we did was we dissected all of those approaches. We looked at all of the indicators that they incorporate into their analysis. And our conclusion was essentially that while we think the debt to GDP ratio is certainly tracking in the wrong direction, Canada's starting off from a very strong fiscal position, and ultimately as its fiscal position degrades, along with all other major developed economies going forward, a big part of that being defense spending, Canada is actually relatively well positioned to continue to maintain a AAA credit rating for the foreseeable future, unless something significant hits Canada as an adverse shock.
Do you think there'd be any commentary from the agencies or a shift in? You would know the terminology better than I, but quite often they put a bond issuer on notice for a potential downgrade, or they change the tone of their rating.
Oh, certainly, I think that's possible going forward. But again, this is at a time when most advanced economies are going to be running larger deficits, are going to be incurring more debt, issuing more debt as a result of the need to fund a larger defense envelope than what they had previously expected. And so a rating is both absolute and relative. So certainly we saw with Fitch back in the spring that the lack of a budget combined with election spending promises by the Liberal Party of Canada caused them to, at least raise an eyebrow as to the path going forward. And so certainly we think that rating agencies will want to see a profile for the debt to GDP ratio, which is on a more sustainable path than we're expecting. But we don't think that that is going to lead to an imminent downgrade for Canada, just given really the very strong starting point for the federal government's fiscal position and gross government debt overall.
One of the points your report makes is that Canada's public pension assets provide an advantage in these calculations. Explain exactly what you're saying there.
Well, generally, what happens is rating agencies actually net out the assets from pension plans, and so they don't include that when they're making a credit rating for governments internationally. And so that doesn't unfortunately help the Canadian government in the federal government in any way in terms of its rating. But I think what it does is it does allow the federal government to avoid this long-term liability or this future liability that other national governments are going to be facing. So while we may not get the benefit of being able to count the financial assets that are held by public pension plans in Canada, we don't have this future liability that we're going to be facing down either.
How important is healthy, perhaps above average gross domestic product growth over the next over the horizon you're looking at in terms of the country being able to maintain this level of spending and this AAA rating?
Well, economists like to talk about R minus G as being important to debt dynamics. So that's your real interest rate, real effective interest rate versus real GDP growth. And ultimately, what you want to have to maintain solid debt dynamics is real GDP growth that is higher than your real interest rate if you're maintaining just a primary budget balance. And so that's something that the federal government, I think, is obviously going to be very focused on. They're investing a lot in infrastructure, a lot in defense, trying to bring down things like interprovincial trade barriers to try to boost productivity, boost output, boost economic growth in Canada. So we'll see if it works at the end of the day. But certainly, if that leads to positive tailwinds for economic growth in Canada, then and ultimately outpaces what we're paying in interest, that's something that will help to improve the overall debt dynamics of the federal government and a broader government sector overall.